Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To get even more content from me and Andrew, sign up for the Focus Compounding app. The Focus Compounding app costs $7.95 a month. It comes with a bunch of 2,000-word articles from me each week, a fresh batch of 5-minute videos from the both of us, along with one bonus extra-long episode of the podcast each Saturday, and immediate access to our complete backlog of 200-plus episodes. To sign up, go to focuscompounding.com/app or wherever apps are sold. And now here's Andrew with your regularly scheduled podcast.
Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, sitting next to Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. This is part 2 to our Q&A series. Be on the lookout for my Twitter account about once a week. Typically on Mondays, I will do a call for questions at Focus Compound, and you can ask a question directly there. The first question is actually my DM, so I'm not going to show the screen from somebody. And let's see. He said, "Hey, Andrew, I keep missing the Q&A tweets. I figured I'd send some stuff. I've been wondering here, and you could use it for the Q&A. Blah, blah, blah." It says, first one, Geoff talks about owning trusts. And I want to actually talk about this because since you said on the dividend paying stocks video that we did for the app, I think it's also on YouTube as well. Mm-hmm. You said that you would not really, if you were worried about income, you would look at trusts. And, there's a few different trusts that you would be very interested in for your personal capital. But he says, so first, when Geoff talks about owning trusts for income purposes, what type of trust is he talking about and how do you find them? And then he said, I would also love Geoff to look back on MSM. Seems like an interesting business and it seems super cheaper than before. And then he asked a couple other stocks, but maybe we could just start with the trust because a lot of people have been asking about that.
Yeah, I don't think I can really give exact answers on that because they're really small trusts that look interesting and stuff like that. I don't know if I want to say all the names of them because I don't think it would interest people as much. They're not the big trusts that people know about and stuff. They're microcap things that are some fluke thing that they exist. There's some that are royalties on stuff. There's some that I guess technically it's not exactly a trust, but it's a trust basically. So we'd mentioned before the cemetery thing. There's a thing that's some coal and timber and stuff like that one. There's ones that are just coal royalty override things, which can go to almost nothing at times. So that means you would have almost no income at times, but at other times on averaged out, it would work out fine. Generally things that funds and stuff, things like us wouldn't buy because of the tax things that it would cause for partners or for people in managed accounts and things like that. Mm-hmm. So there's a lot of stocks that you see that I think people don't buy because of the complications of it. Sure. We have mentioned some trusts before, like Mills Music Trust and stuff. Mills Music Trust isn't necessarily all that cheap all the time when we talk about it, but things in that category in terms of how small they are, how illiquid they are, and what kind of things they are. That's copyrights on songs. So that sort of thing. Yeah.
I guess the right question is, if you were to look at a trust, what are some things you would be looking for?
Trusts are pretty easy to value. So you would just look for something that, on like a DCF type basis looks really attractive. As an example, let's say those copyright songs, Mills Music Trust. If you thought the value of songs would go up 3% or something over time, and then you could get it at a yield that would be attractive, because basically your yield would become a real yield if they can, if pricing can increase that much. Sometimes there's some complication stuff. Mills Music Trust, which I wrote up, I think they don't get paid as much from their music publisher as they should. And I think that's known, and they audited them before and stuff and got catch-up payment on it and stuff. And that's very common. I think almost all publishers try to rip off the trusts and things that are, different people are entitled to royalties, and then eventually pay up on it. That's not unusual. So there's little things like that, but it's a very simple thing to read up on. All these things are like accidental stuff. I mean, we could get into it, but the trusts that interest me are ones that were never promoted and stuff as trusts. They were created for some reason, which would make sense for a trust, where they had to resolve some legal issue, or a family had no other way of doing this, or they had to spin something off sort of and get rid of something. And you can read about the history of them sometimes in the trusts. But yeah, so as an example, there are trusts that are literally like royalties on stuff. There's natural gas, but there's also like coal at some location. And why is there a royalty on coal? Why is there tradable trust that's just royalties on a few mines that you could go look up and learn about? Probably because there's some reason why the company ended up with them and then wanted to turn them into something that could be monetized or whatever, or at least separated from other parts of the business. It was something non-core to them. So yeah, things like that. Not at all what people are thinking about with like, anything that gets promoted and that people are interested in. All very small microcap stuff, like almost nano cap. Usually, a few are just very illiquid. The one I mentioned about the coal and the timber, a beaver coal is, I think it's been around 100 years or something. And you can look into the history of why it exists and everything.
Yeah. Why do you think, and you just sort of said it a second ago, when you and I have talked about this, a lot of the companies we look at, the way they go public is usually kind of non-traditional.
Yes.
Why is that the case with a lot of the companies that we look at?
Well, because I'm looking for something that's clearly and irrationally cheap. And the reason why something becomes clearly and irrationally cheap or clearly and irrationally overvalued usually has to do with the amount of promotion behind it and things like that. So this is true for Buffett too. Like he made investments in, if you look, blue chip stamps, had a very weird history of why that happened and even how he got some of his shares. I mean, Buffett actually bought shares in a grocer so that he could then go to the grocer who had been given the shares of blue chip because of the consent decree is a legal thing that had been distributed to them to swap shares in blue chip back to him for the shares that he had in them. Right. So there's the one. Then he had another one where he sent someone out to go find the shares and stuff. And that's because it had been a scam. And then it was a scam that turned legitimate. And actually, that's a very common way of finding really good stocks, to be honest. If you can ever find stocks where the public company, the corporate form that you're looking at was at one time a scam, it was run by someone committing fraud, and then actually there's a legitimate business there and someone over time rehabilitated that and stuff, that honestly is the number one best way I've ever found to find a successful business that's just irrationally cheap and stuff. Once something was a scam, then people won't notice when other players in there turn it into something legitimate. And sometimes there are things like that where I've talked about this before and like try not to say the names of the companies and stuff, but there's a couple companies in the US which clearly were a legitimate business. There was no doubt of whether they were fraud. However, criminals had major control of them or influence of them or affiliates of them had it. And so it became a real issue and no one would touch it when that was happening. And if eventually that situation changes, then you have something really attractive that way. And that's even true for giant companies and stuff. Like people probably paid way too much for Tyco when it was doing acquisitions and all this stuff. And then once it all imploded, they probably valued it too low compared to what it could be broken up for its parts because it had been acquiring legitimate businesses all those years. You know? Yeah.
So it's just kind of, it adds to, I guess, the off the beaten path. A lot of those companies tend to be in that box because they have a negative shadow over them because of the history and stuff like that. Yeah. Even if the company today is not like what they were 10 or 15 years ago.
Yeah, absolutely.
Next question. And I guess we have to answer this because I am drinking a Celsius right now. It says, how about diving into Celsius? If one figure's odds are better than 50% that it will reach 25% of Monster's revenue in the next 5 years, isn't it a good investment at this price?
Well, we could figure that out mathematically. So let's go to Quick FS, I guess.
If you want to sign up for Quick FS, tell them you came from Focus Compounding. All right.
So the company's market cap today, I'll just use market cap and stuff. Okay, 1.5 billion. Then give me Monster.
Oops, not that one. Okay. 43 billion.
43 billion. And he said 25% of their current revenue?
That it will reach 25% of Monster's revenue in the next 5 years.
Okay.
So that's 4.2 billion. Is the current revenue. So 25% of that. So figure like $1 billion.
Okay. Yeah. So, I mean, if it gets valued the same way as Monster, yes. The answer is yes. I mean, we could do some math on trying to figure that out exactly. But
so that's Celsius reaching $1 billion in sales within 5 years.
Right. Do I believe the probabilities of what he's saying? No, I don't think so. Let's see what the probability said. He said 50% probably.
Yeah.
So it's going to be up 10 times in 5 years?
That's what he's saying. Yeah.
Okay.
But I guess that wasn't his question, right? His question was, so if they can do that,
Yes.
is it a good investment at today's price?
If they can do it, yes. We don't have to worry about the probabilities. But yes, I could do the math on that easily. So so if they have the same valuation as Monster has now, but of course Monster's comp could decline and stuff, you can do that easily. Monster has a market cap of, I'll
pull it back up again.
yeah. So this can be simplified pretty fast. Monster has a market cap of 43 million. Divide that by 4 because you're assuming that 43 billion. You divide that by 4, round it down, you're still at 10 billion. Market cap on Celsius is 1.5. So you'd say, okay, well, what's 10 billion? You then take 10 billion and say, okay, what if there's a half chance that Celsius goes to 0, which is just, I'm adding that in to make the calculation simpler. Then you just take 50% of the then market cap that we just calculated out. So 10 billion when we go to 5 billion. If 1.5 billion turns into 5 billion, that's more than tripling within 5 years, which is obviously very, very high. In fact, you can calculate it, but you're assuming a lot of things here, but you could calculate it so it has a much lower probability. In fact, you'll probably beat the market in it, even if the probability is significant. The probability is significantly below 50%, very, very significantly below 50%. But remember, Monster has a pretty high multiple. Mm-hmm. So I'm assuming two things. I'm assuming that can do this, which I don't necessarily believe. And then, so your sales growth will be really high in the next 5 years or whatever. But 2, I'm also saying that your multiple will be as high as Monster, whereas Monster's multiple could collapse by 50 or 75 or whatever percent. We don't know in a short period of time too. But yeah, on the probabilities, yes, we can, I could go through it exactly, but even if there's like a 4 out of 5 chance or something, I don't think it means you'll do worse in the market, because I also picked a 0% decline to nothing, which is unlikely if it doesn't happen. You're not going to have the stock go to nothing at this point. So,
and I'm drinking a Peach Vibe limited edition sparkling white peach. First time having it. So had to answer that question. And it kind of doesn't, it tastes good, but it tastes like every other drink they have. Okay. How to calculate an insurer's, i.e. progressive retention rate?
Oh, you can't calculate it, but they can tell it to you.
A lot of times if you look at companies' investor relation or like presentations and stuff like that, they'll break it out there.
Yeah, you have to be very careful in terms of what they say, exactly what the retention rate means. So it depends. The best calculation retention rate would just be a straight up retention rate thing that they tell you. However, you have to understand that for a lot of companies, your first year retention will be very poor, and then after that, retention will be a lot higher. So sometimes what they're giving you is retention rate on seasoned business, which you should pay a little more attention to if they say that or what they say in the footnotes and stuff. So like for a bank, it's not unusual for them to lose 1 out of 3 customers in the first year, but then to retain more than 9 out of 10 if they make it through the first year. And then I've seen really weird things with tech companies and stuff. Tech companies seem to like to use, basically what they're using is dollar retention rate. So if they have a customer pool of 100 customers, they raise prices by 10% during the year. They bundle some things so that they sell them another 10% of things, so they got 20%. But then actually 15% of the customers left them. They would say their retention rate is 105%.
Mm-hmm.
So
we actually did a podcast on that once.
Yeah, so that's interesting. So it depends. You have to look carefully. I'd say a lot of them are using seasoned business, which is fine. It's like a good number to use and stuff. I don't disagree with that. But what it would be better is if they broke that out and said, here's our first year and here's our second year. So just read very carefully what they're saying. And if you can talk to investor relations or something, they'll clarify that for you. Actually, retention rate is something that I think they're very comfortable telling you about. Usually companies know it, and they can tell you how they calculate what they put in their reports.
Next question, warning signs that a dividend cut is imminent. Always wanted to know more on that front.
I don't know. I would say generally companies that cut dividends, with COVID and stuff, there's nothing that was going to happen. You have low free cash flow generation relative to earnings. So poor quality of earnings, basically. You have high asset growth often. This is contrary to what a lot of people expect, but companies that kind of just are stagnant or shrinking are usually not going to be a situation where they're going to be raising their dividend too aggressively. I have seen in like one case or something where they just kept raising their dividend even though they weren't growing. But normally what's going to happen instead is a worsening quality of the business while still actually growing quite a bit. That's also a big sign for like credit problems and stuff too. People expect that it's like a company that stalls out and barely grows and then it has problems from that. But that's usually not what happens. It's that they actually are trying to keep up the same growth rate, but the quality is getting worse and worse. The one of the best examples of this would be like, because we talked about this book a bunch, GE and Lights Out and stuff. That's a really classic example of this kind of thing. It's a company that's trying to achieve the same growth rate and stuff over time, but the quality of its earnings and everything is getting worse and worse. So poor cash flow figures with it, pretty aggressive and like insistence that you raise the dividend by a certain amount all the time. So I would say like focus on earnings per share instead of cash flow numbers, increasing leverage over time, decreasing cash balances and things. Focus with a pretty aggressive growth rate in the actual dividend. Like, so trying to grow your dividend by 3% a year over time is not going to cause you a lot of problems, but targeting numbers of 7, 8, 9, 10% while your cash flow isn't really following that. So I would say as long as your free cash flow is consistently like things like free cash flow and even cash flow from operations, if they're consistently coming in above the growth rate in the dividend, I don't think you're that likely to have the problem. But where you will have the problem is if you're seeing that they've raised the dividend faster than they raise things like free cash flow. Free cash flow might be a little rough on the company. So you could say cash flow from operations. I would strongly say that if cash flow from operations does not grow as fast as the dividend, that's starting to be a warning sign. And if that's coupled with growth in debt, then definitely. Why they'll actually cut it can be things like they decide to do an acquisition. But if they hadn't had that problem in the first place, then they wouldn't need to cut the dividend.
Speaking about Lights Out, I really recommend everyone to read it. I mean, they had an internal audit team that would go to each business within GE and would think of ways it would be rewarded if you came up with almost like financial engineering things to make profits look higher, which was totally legal, by the way, but just like it didn't change anything of the quality of earnings. You know, I mean, it's just the incentives there were just mind-boggling. That's probably one of my top books I've read in 2020.
Yeah.
I think it was a great book.
Good.
Believe it or not, here's something funny. Yeah. So my Kindle, I lost my Kindle on our trip, guys, okay? I didn't tell anyone, but I lost it, all right? I called the hotels and no one knew where it was, all right, guys? So I bought a new Kindle. Geoff he offered for me to have his old one, but I didn't. And you were reading on yours when I got here today. So there you go. Okay. I read on landscape mode now. Have you ever read on landscape mode on the Kindle? No, it's actually a lot better than I thought it would. Yeah. Someone recommended it on the internet. I was looking at just reviews of this Kindle I bought. It's just the Oasis, but landscape mode, try that out. Next question. How important are infinite returns on capital for an investment decision of yours? Is it more like the icing on the cake?
So this is risks getting mathematical here, but so there's the way I think of it has always been you're sounding very mathematical, but I've always said to people, look, your returns in a stock are going to approach two potential constraints, two limits that they could bump up against. One is your initial yield in it and stuff. So how cheaply are you buying something? So this is why, like, if you buy something at a PE of 1, you can get incredibly high returns. Okay. And if you buy something that has infinite returns on capital, you can get incredibly high returns. The problem is that most things are going to fall really in between that. And so what will happen is, like, if you buy something at a PE of 1, it goes to a PE of 5 in a year and you sell it, that's an amazing return. If you buy something with infinite returns on capital and hold it forever, okay, Amazon, we talked about it, it's like that's the kind of thing. On a cash basis, it's had nearly infinite returns on capital and stuff for a long time. So that's why you can have a very high return even though you paid a high price. So the answer is it's incredibly important as you approach anything that's a remotely high price. So it's really, really important to me. The only way that I'll pay meaningfully high prices that, like, I mean, not even prices that even other value investors consider pretty good prices,
like
but
20 to 30 times earnings
is if the company has infinite returns on capital, because without that, it gets a little tough to get the kinds of returns that we would want. One thing that I think of when buying a stock, the common way of thinking about it is, can this return in a reasonable way? Can this return 10 times in 15 years? Okay. That's about a 17% annual return. The way you break that down is it's much easier if it's very cheap. So if you have a P of 4, then it could go to 12 or even 16, or it could go to 20 if people really believe this is a great company. So if it does something like that, it barely needs to grow at all. All it needs to grow at is 4 or 5% a year or something, or pay a 4 or 5% dividend yield if it goes from a P of 4 to 20. So it's often easier to find a company that's completely just an okay company, perfectly good company that's trading insanely cheap. But if you're trying to say you're buying a company at an average PE, then infinite returns on capital become really important to me. So if you're seeing me buy something at 15, 20, 25 times earnings, you're not going to see me buying 25 times earnings probably. But if you're seeing numbers that are more normal PEs, 15, 20 and stuff, then infinite returns on capital become very important. And also, by the way, retaining almost all your earnings become really important. I've looked at some things and talked to people about it. And one thing that'll surprise them is with banks, for most banks, it's not as important as you think what the return on capital is, because most banks pay too much out in dividends. But you do find a rare bank that actually has really good returns on equity and is retaining a huge amount. And so my valuation changes a lot because of that retention.
And to your case about paying 25 times earnings and the business having infinite returns on capital, that's because you're paying a lot for that future growth? Or you want to look cheap for that future growth, I should say?
Well, here's the deal. So I always flip it. I actually think of it in terms of that, how much capital does it take to grow a certain amount? So let's say you pay 25 times free cash flow. Okay. So it has to be free cash flow, not just earnings. 25 times free cash flow gives you a 4% yield. Let's say you want 10, 11, 12% a year. Well, now you got to grow 6 to 8% a year. But if you're growing 6 to 8% a year with infinite returns on capital, see, without the infinite returns on capital, you then have to use some of your free cash flow. So that free cash flow is not truly free. People count it as free cash flow, but it's actually being reinvested in the business. So if it's 4% and that goes down to 2%, then we have a problem, because now I have to grow even 2% faster to get those kinds of numbers. So, a way of looking at it is, and it's not perfect, but an approximation that's very easy for people to do in their head is free cash flow plus growth. Now, this gets into issues of how long does that go on for? Does it go on for 100 years? Then it works. But if it goes on for only a few years, it doesn't work. But let's put that aside. Free cash flow plus growth. It's much easier usually to have a business that has a true free cash flow yield of 4 or 5% and also grows 4 or 5% a year to give you a pretty good return. Maybe not a lot better than the market, but not worse. That's usually a lot easier than the reverse of growing 10% a year or something like that. What happens is some people get excited about a business that's growing 10% a year while reinvesting every dollar it has. But actually, that's only a mediocre return. That's actually not that different than what the market will do, because you're using every dollar of your free cash flow to do that. So, yeah, it's the easiest way to think about it is free cash flow, meaning actual free cash flow we'd have to pay you even while we're growing, plus growth. Yeah.
And to his point about, is it more like the icing on the cake? And your point about 1 PEs, it was J&J Snack Foods. What was it, 5 times, 6 times earnings? Do you remember what it was trading?
Well, J&J was 11 or something.
Oh, it was 11? Okay.
And it went to 30. But Village was.
Got it.
Yeah, so it went from 5 to 15 or something pretty quickly.
How much would Geoff charge today for 20-year option rights on producing a Geoff Gannon investing documentary? And someone said, I suggest the title Behind the Flannel.
I charge a lot to discourage it from happening. So I think.
So you'd pull Paul Tudor Jones, huh?
Is that it?
You remember we were talking about that, how he has a documentary out on him, and he just has done everything over the years, even 20 years later, to get that video gone.
Oh, okay. Yeah, I do the opposite of Stephen King. Stephen King, if he likes you or whatever, to give you a chance, will option for $1 for you to do a student film or something on one of his books. You can't do it for a big commercial production. I would do the reverse of that. I would just make it incredibly expensive to make sure it doesn't happen.
I would say Trey should reach out to the agent, Andrew at Focus Compound. Okay. I got a 10% royalty, kind of like the Ari Gold. We that's Entourage for people that don't know. Geoff likes Entourage. We like Entourage. Next question. Do you agree with Bill Gross? Bill Gross says investors should use leverage right now to boost returns since central banks are unlikely to raise rates in the foreseeable future. Bill Gross said, you've got to lever. You've got to be able to borrow.
We won't be using leverage, but what he's saying makes some sense. So, and that's actually part of the problem of like, rates being here where they are. It makes a lot of, certainly for businesses and stuff, it makes a lot of sense for them to just borrow and buy all sorts of things that aren't, they wouldn't normally do. But that's the point of interest rate policy, is to encourage investments and stuff that otherwise wouldn't happen. Well, to encourage real economic activity that otherwise wouldn't happen, to encourage building a road, build it, because you can issue bonds and stuff that cost like nothing. Building a housing development that you wouldn't otherwise do. I mean, years ago, the example I was given was railroads and stuff. So yeah, but like, should companies take on debt and recapitalize and everything? Yeah, I worry about that, but yes, it would make sense. There's almost no companies you can think of that we would invest in stuff where they really shouldn't take on a ton of debt and buy back their stock, or take on a ton of debt and even make a so-so acquisition. There's some companies that can, after taxes and stuff, you could finance some things at 3.5% probably for a good long time after tax, after you count the tax break.
So we're at 25 minutes, but there's a couple that I actually wanted to see. What is Geoff's thoughts on health and longevity?
My health and longevity? Whose health and longevity?
Let's just say, generally speaking.
I don't really have thoughts on health and longevity.
And then there was one question. Where is it? We have a lot of questions. This one. Any thoughts on Peter Kamen and his style of investing as exhibited in his holdings like CLWY and TTSH?
I've read the documents.
This was my response.
I've, as you can imagine, I've read the what is it? I guess it's a lawsuit. Yeah, I've read the lawsuit, all the documents related to the lawsuit.
Title shop.
Yeah.
Any thoughts on that style of investing? Not something you would do.
Callaway's a little too. And Callaway's is around here, locations
sure
around
is.
here and stuff. Some of them, yeah. I followed them both, I've looked at both stocks. I definitely looked at both stocks but looked at it a lot more than you might think. And read up the documents and stuff on whatever disclosures are public about that and stuff I've read. Yeah. What else with that?
Do you have any thoughts on that? On his style?
On his style?
What he's, in that lawsuit for, I guess you could say.
I feel like
what he did.
Oh, I just feel like Callaway's and Tile Shop are kind of different situations. Tile Shop for business reasons and stuff, I'm somewhat, I don't know. I was somewhat reluctant with the business of Tile Shop more so than Callaway's. Callaway's, I felt like I could understand better, and there was hard value in the real estate and stuff. Tile Shop is a very high gross margin, but it's kind of high need to generate a certain amount of volume and stuff, and could be potentially cyclical. So I feel like it's a very leveraged sort of thing if it works out, but it sounds operational to me, that way of like, if you get it to work. I don't know. Tile Shop just struck me as more operationally complex than Callaway's. What did you think?
No, that's probably true. I think he's probably asking like company going dark, cratering the stock price, and then, buying up a lot of stock, sort of that whole side of what's going on with that company.
Yeah, I've read the documents on that. I don't know. I find it interesting that I don't know. I've read the stuff about it and thought about that, sure. But that's more of a question of like, would I invest alongside him or something?
Sure.
And like, would I trust that?
That's the thing. You read like the Tile Shop, like message boards and stuff, and people are like, oh, well, he did this, but it's like, but he's going to make the stock go, or they feel very bullish. I'm like, would you want to invest alongside someone like that in that situation?
I don't know. And to be fair, I did also read things where I said to you, I was like, I think there's more, I don't know if I want to get into it and stuff. I got the feeling that someone was upset about things that were other than just what happened in that case, actually. I don't know all the details, but I think someone felt personally hurt about some things, and some of their...
It's personal.
They became personal in some ways, sure.
Back
and
for vengeance.
You never know all the story there with that.
It's fun to watch from the sidelines, I guess, or read about it, I guess. We're not involved in any way.
Right.
We have looked at both. We've been following TTSH for over a year now.
It's incredibly unlikely I would invest in either one. And I don't feel, unless I found out a lot more about him and stuff, that I would invest in a company alongside him, though it could happen accidentally. I mean, that is a thing that could happen with anyone in that space because it's a pretty small space. We invest in.
It is a very small space. We've learned. Come across a few people. I'm like, oh my gosh, this person again.
So we sometimes invest in some companies that are in the same sort of categories and stuff like that. Yeah.
Got it. Cool. Well, I don't thank everybody so much for tuning in with Geoff and I. Sorry that we weren't able to get to all of the questions. Be on the lookout next Monday. We'll do a call for questions, and then we will do our best to answer all of them. We're going to dedicate 2 episodes a week to it. It's good to answer any questions on everyone's mind as much as we possibly can. I want to thank everybody so much for tuning in. Hit that subscribe button, and we will see you in the next podcast.